Great, thanks so much. Hi, everyone, and thank you to the MMSteelClub for the invitation to speak.
Hey, thank you very much. And I want to introduce myself quickly. My name is Matt Black. I've been in the steel business for, I guess, a little over 25 years now. A lot of that was on the service center side as well as the trading side. And I've also been a partner in a couple of startups.
And thanks for MMSteelClub for having me on the panel. I'm going to speak about in the downstream industry from a kind of end user demand perspective.
Years ago. Interesting to see yourself that way. First of all, I've been involved in the industry a very long time, since the early 1970s. So I've gone through a lot of different cycles on all the commodities, and I've studied and consulted and written about and priced a lot of commodities.
A lot of banks are implementing LIBOR floors. And the reason for that is because LIBOR, the base rate, the London interbank overnight rate, has fallen to 7 or 9 basis points. And a lot of banks aren't making money at those levels. If they priced a deal in normal credit environments when LIBOR was much higher and it's fallen off by 50 or more basis points, then they may be losing money depending on what their cost structure is. So we've seen them implement LIBOR floors of between 25 and 100 basis points. 25, I would say, is on the more frequent side. 100 is a little bit on the rich side, but that's what we're seeing out there. They're usually not adjusting the spread, meaning the borrowing cost over LIBOR, and that's good for borrowers because it allows the borrower in 6 months' time, 9 months' time, whenever things normalize, go back to your banker and ask them about that floor they put in place. They are supposed to be temporary.
They would come and go. They would impact a very small part of the import supply chain to the U.S. Domestic mills traditionally would file anti-dumping, countervailing cases, and they would be filed against specific mills and specific products from those mills. Normally, the penalties for those ranged between 2% and maybe 7 to 10% at the highest rates. And as I mentioned, the impact was relatively low. Didn't affect a lot of pricing, and there was enough imports from various countries that if someone had to sit out for a while, there was plenty of supply.
We've been doing and completed recently a multi-client study that looked at aviation and aerospace, primarily looking at, first of all, what the different COVID scenarios might be, how that would then impact the resumption of air traffic, and then what that means for what the production, the outlook for aircraft production. Most aerospace raw material consumption is production related. There is some that is related to maintenance, repair, and overhaul of airplanes as well. And in particular, we did a deep dive on the various airlines around the world and classified them in terms of viability. Airlines that are probably in pretty good shape, or the government has a good rescue package for their industry, all the way down to those that are not faring so well. And the reason we wanted to do that is we wanted to understand, okay, for those airlines that the outlook is kind of iffy right now, that their backlog, the orders they have placed with the aircraft and engine manufacturers would be at greater risk. And we wanted to understand that and as an input to our new and updated aircraft production forecast.
But there are similarities and dissimilarities between all of them. The similarities is that usually you have a social and economic result, okay? And you could quantify those pretty easily. The social effect is what happens to how society deals with it, and the economic effect is what the governments or what individuals do during this time. You've added another component here, and that's the medical effect, because we have a virus that's covered the world. So when we talk about 9/11 or even World War II or the Great Depression, it wasn't a world event. sometimes it was close to a world event, but this is truly a world event. But the one factor that we don't, and we really can't quantify, is the psychological effect. Now, when people talk about recovery from the virus, we could recover in the fact of medically, we could reduce the mortality rates to near zero, we could come up with the idea that we have an effective treatment with it. But the question is, what is the singular, how long does this depression last with us?
Good. Good afternoon, everyone. Thank you for having me today. So I'm going to change the pace and talk a little bit about minor metals, not so much steel, but it was very interesting for me to hear the first part because that was my prior career. So it was interesting.
Good afternoon, everyone. I'm Chris Shipp, like I said, Vice President of Supply Chain for Prefer Manufacturing. First off, we want to send out well wishes to everyone during this time of crisis to stay safe. Also, thanks to MMSteelClub for the opportunity to represent the manufacturing sector.
All right. Well, good morning or good afternoon, everyone, depending upon where you are in the world. Quick thank you to MMSteelClub for the opportunity, and also to my esteemed colleagues here on the webinar. Pleasure to speak with you, and of course to our audience. Thanks so much for joining us here today.
Good afternoon, everyone. Being the last speaker in a panel of 8, probably you have heard everything, and I'm going away from my prepared notes to talk to you from the perspective of a steel maker rather than a consumer or a trader or a banker.
We also see gallium as a big one because gallium is used in devices for lasers, LEDs, power amplifiers, transceivers, also blue lasers, blue LEDs, and high temperature electronics. It's usually the second, it goes into gallium would be combined with arsenic or nitrate to actually make those devices. And then those devices go into various end products, whether it's lighting, cell phones, a Wi-Fi base station, or lighting. So gallium is very essential for many technologies, and we are seeing actually good opportunities in those markets.
Like the stock market, steel futures kind of tanked during COVID-19 and then started to rebound. A lot of people in the industry expected HRC to hover around $450 a ton. The futures curve last Friday really shown in white on the screen. It is, again, futures are now hovering $525 a ton. Average looks like the rest of the year right now. The curve is showing steady increases. I think we'll probably hover closer, in my estimation, around 500 a ton. If not lower, as we head into the year. Again, it's a lot of speculation due to supply and demand and how the industry deals with the potential overcapacity.
Moving on to steel scrap, the focus here is a little bit different, right, as we think about impacts to pricing. Of course, significant supply chain disruptions, namely reduced supply. To quote the Cleveland-Cliffs CEO, there's plenty of use for scrap, but it's not being generated, and that's impacting supply adversely. U.S. exports specifically are down 16%, and U.S. factory outputs are the lowest in almost 72 years. So, COVID-19, of course, is the scapegoat here primarily. So, that'll be sort of a recurring theme as we discuss some of these other asset classes in the metal space as well.
The COVID resulted mainly in bringing the market to a complete standstill, and that primarily happened because our customers stopped consuming, be it automobiles, be it furniture, be it goods of different kinds. The consumers stayed away from the market, bringing down the demand rather sharply. And on the other side, when the oil crisis hit us, The tubular market suffered the most, and tubes being made out of primarily hot roll coils and plates to some extent too suffered, and flat product especially took the brunt of it. Social distancing led to stop in construction, closure of retail sales, houses were stopped, the construction of houses stopped, and this resulted in a lot of steel inventory and very low utilization.
Yeah, so from our perspective, we're seeing a lot of the same things you guys are. It was interesting to hear the discussions around infrastructure as well, because that's obviously something very politically motivated and important. For us at Tubular, we're really focused on, from a Canadian standpoint, the USMCA, and then also the automotive industry in general. We do have locations in both Canada and the United States, but our Canadian facility is one that needs all the help it can get from a trade perspective, and the government of Canada probably should be stepping up their game a little bit more. Starting to see with USMCA, a lot of the large companies are starting to ask for companies to the paperwork and all that stuff starting to flow. We're starting to see a lot of webinars and all that, getting people educated on that. Now, we also noticed this morning there was a little bit of talk in Congress on Wednesday. It was only reported late last night, but somehow Trump and Lighthizer are talking about tariffs on Canada and Mexico again, steel tariffs. So I haven't really seen that anywhere else, but it was reported lightly in Canadian media. So that's something that we're tracking very, very closely and hoping that that goes away. Not sure if that's a last minute positioning towards USMCA or how that all interacts, but that was kind of surprising to see because we all thought that was put to bed. We are seeing too, from a Canadian perspective, certain buyers are in the United States are wondering if it is safe to buy out of Canada. So, you know, I think damage has been done regardless of what happens. So that's something that we're watching very closely. And then just automotive overall, is the consumer going to come back? For Canadian consumers, everything is tied to housing. So if housing continues to stay strong, then no reason cars won't continue to sell. Not sure the correlation in the United States if it is as strong, but certainly there probably would be a fairly strong connection there as well. So we're trying to keep an eye on that. Yeah, that's kind of just where we're at. I think it's very touch and go, seeing what the fall is going to bring. A lot of uncertainty around the elections, around the money running out for both Canada and the United States have their employment benefit or whatever you want to call it, that we're keeping a close eye on. Prime Minister Trudeau just extended it for another 8 weeks. So a lot of uncertainty out there, that's for sure. Making decisions on how much steel to buy and at what price to buy it is certainly a hot topic right now, that's for sure.
Ernesto, go ahead.
Okay.
Thanks.
Hello, everyone. My name is Ernesto Rivera. I'm a sales manager for TMI Corporation. We do automation for the steel producers around the world, and I'm based in the US. Well, everyone agrees that right now we have uncertainty around the world and mostly in America, US, Mexico, and Canada. But with everything that is happening right now, do you think that CAPEX is going to increase in the following year? Maybe not 2020 because we have COVID-19, but maybe 2021 with the elections in the US and all the shifting that we're having between Canada, US, and Mexico with the USMCA. So I would like to know what you think about that.
Yeah, I mean, capital expenditure, that's a great question. I think you've got a lot of business owners in the segment that I'm dealing with really hesitant at the moment. And it's really a function of the rate of recovery. I mean, the capital is there. Banks are willing to lend. Banks are really looking for firm commitments though, right? So for big capital projects, banks will look for those taker pays. They'll look for really firmed cash flows that they can expect to receive due from creditworthy, high quality companies. Otherwise, those more speculative projects are, I think, less likely to be funded. When it comes to actual numbers, I think you're likely to see some concentration in X energy manufacturing. Energy prices, there tend to be a bit of a psychological and frankly economic break-even point around $40 a barrel. So unless you see crude really hovering, 50 plus for a while, you don't see those big, interstate pipeline projects get announced or planned that frequently. That's I guess that's my thoughts on capex. The capital's there. It's just all about the contract.
That makes sense.
Well, let's take a step back there. In 2008, we had the TARP program. For those people who want to remember that, I mean, we spent $100 billion on the TARP program, and we went around the country. The administration at that point ran around the country with these huge checks, big checks in cardboard announcing infrastructure and shovel-ready projects. Remember the shovel-ready projects? How much actual infrastructure were made? First of all, the question is, when you give money to a municipality to do infrastructure, a lot of the times the money isn't spent on infrastructure, number one. They're spent on a lot of different things rather than infrastructure itself. The other thing, infrastructure takes time. If somebody wants to build a bridge or a tunnel, you've got to go through the environmental impact statements. You've got to go through the various other categories in order to actually start it. So therefore, if all of a sudden Trump says we're going to spend $3 billion or $3 trillion on infrastructure, when would that money actually be spent rather than on studies and everything else? Probably, depending on where it is. If it's in California, it could be 10, 15 years. If it's anywhere else, it could be maybe 5 years. So therefore, if you think you're going to get an immediate boom from infrastructure, you're crazy. That's the first thing. The second thing, that program didn't work. There's a lot of other programs, but that infrastructure didn't work. Those shovel-ready projects didn't work. Probably the biggest infrastructure spending was Japan, right? Remember the real estate bubble in the 1970s and 1980s? Japan decided they were going to spend equivalent of $1 billion in infrastructure. They paved over the country. They built airports. They did everything. Did the infrastructure help? Infrastructure spending help? No. In reality, Japan went into a recession for over 15 years after putting the infrastructure program into effect. And the reason why, how many people believe in the multiplier? The idea is you've got to give it to people who spend the money, okay? Infrastructure it sounds good. The construction unions love the idea of infrastructure. Is it a good economic policy? It's great to announce. That's about all that it is. But don't ever believe that infrastructure, $1 trillion, is going to spur the economy in the next 6 months, year, or 5 years. It's impossible to believe. We keep making the same mistakes. And I can't believe how many people ask me about infrastructure. It's stupid.
Yeah, I think if 232 goes, as I mentioned before, I think the markets have already become used to it. And if you look at the spread that 232 created, that spread is declined rapidly. There's really not that much of a spread between imports and the domestic pricing right now. There are other measures, anti-dumping, countervailing. I think you would see domestic mills rapidly put in complaints and cases to the Department of Commerce. So I don't think it would be a massive event, and I think any administration that came in and took 232 away, chances are they're going to rename parts of 232 under some new kind of trade policy, and they'll slowly ramp it down.
Yeah, I think this 232 is something the steel industry wants. The trade unions want it. So there are very few people who are really now clamoring for 232 to be taken out. The initial clamor has kind of died down, and as Matt pointed out, the price differential isn't really much, except the steel plants are all healthy these days. These 2 years of 232, we don't see blood on the floor. Many of them have been able to shore up their balance sheets, which is perhaps good for the steel industry. It's only the guy down in the supply chain who has to compete with a product which comes in, a finished product, cheaper than buying the raw material from the steel producers and then converting it. He's the one who is suffering. Other than that, I think politically it's great. You have a constituency backing it. So probably till the near future, 232 will remain. But 232 coming in or taking out is purely political and lobbying. So I don't know. I don't think I can crystal ball gaze at the politicians.
Oh, absolutely. I'm happy about it. I mean, more than anything, I love the messaging around mitigating risk and identifying opportunities to create better price certainty, you know, irrespective of where you think the markets are going to go. So I, for one, am all for what Mr. Shipp has here in the bottom of his slide.
No, I agree. I think all of us that are, you know, in whether service center, whether manufacturing, anything to do around commodities. I mean, it's well known. Not using hedging is one option to control your risk. I think that's it's critical in volatility. I think it gives us definitely options. You know, from being I'll put my service center hat on, working with our customers on the service center side. To help them lock in their profits too and give them longer term pricing. That's the way we can do it, right? If you want to lock in someone's price for a year or 2 years, there's the avenue to go. We can both lock in our margins and make what we want. So I think it's you know, I do consider it critical. Put my manufacturer hat on as well. You know, our farm and ranch equipment, we reprice every couple of years typically. You know, 232 changed that, but you know, it does gives us opportunities to you know, to do that, you know, with our customers.